According to a newly released report by the National Bureau of Statistics, (NBS), the total capital importation into Nigeria rose by 210.16% to $3.3 billion in the first quarter of 2024. This is against the $1.1 billion recorded in Q4 2023 and Q1 2023's $1.13 billion, indicating an increase of 198%. Muktar Mohammed, CEO, Asheer Investment Limited, joins me for more on this. Thank you, Muktar, for joining me today.
Thank you for having me, Patricia.
Okay, so on the one hand, data from NBS reveals that Nigeria attracted $3.38 billion capital inflows in Q1. However, debt instruments make up 94% of the inflow. How impressed are you by this rise?
Not impressed at all. But again, that's been the central bank policy. They want to attract inflow. That's why they are giving high yield in dividend in fixed income market. So I think for them, they will think they are achieving their results. A lot of foreign investors are coming in because of high yield. And that could be a success story for them. But for the businesses in Nigeria, that is a very bad story. But again, like I said, they prioritize earning effects into the economy through a short-term means of attracting through the hot money and to the detriment of growing the economy, because they are looking at, can we attract effects to stabilize the rate? And unfortunately, the rate is not stable, even with the kind of inflow that they are seeing, because I think they may have experienced more if the rate is very stable. But for now, I think they will congratulate themselves that they've done well.
Well, let's take a look at the distribution. We saw portfolio investment ranking top with $2 billion, accounting for 61%. And that was followed by other investments with $1.1 million. That's $1 billion actually, and then that accounted for about 35%. And then we have FDIs recording the list with $119 million. That's 3.53% of total capital importation in Q1 2024. How worrying is this? Seeing FDI recorded only 3% of the inflow. Maybe you also help us understand, the difference between what we talk about FDIs, FPIs, and what these other, instruments sort of mean.
Okay, in layman language, the foreign portfolio investment, which takes so much of the penalty, is what we call the hot money. The FDIs are investment in companies for the long term, people that are looking at the long term to be in your country to invest and also to provide employment for your citizens. And so that's the FDI. So what it means now, we are attracting hot money into the economy. And that is portfolio investor. They are here for the hot money. They are here because of the value they get in terms of returns on their investment. And sometimes this investment would go for 180 days, 90 days, 364 days, and that is what is called foreign portfolio investment in terms of what we call the hot money. And so this money could be spread between the fixed income space and the equity market. But what we currently are witnessing, I think mostly are in the fixed income space. If you look at some of the institutions, some of this money passed through to come to the country. So other investment also, you could see that is low, but foreign direct investment is the key to any developmental project in any economy. But people will argue with you normally and say that it's foreign portfolio investor that automatically becomes foreign direct investor in the long term. But that we might wait to see. It also still depends on what the numbers are going forward. What type of investment were they able to have, and what kind of returns do they have on their investment in terms of repatriating their investment back to their respective country. That's what will attract them to become a foreign direct investors. And the challenge here is, come to think about it, if they're exiting at 90 days and you don't have enough FX to do the two-way system, then you might be back to where the dollar to the naira could just be going high because of the exportation of this money is more than the importation that you enjoyed before. So, and you'll be exporting to them at a very higher rate compared
to Muktar, just before we go, I want us to Okay, I want us to, tidy the loose ends. Now, how do we sort of have a shift in the distribution such that we're not acquiring more debt? Because you gave an analogy, what happens if it's time for exit and we do not have enough dollars for them to exit? But rather attracting real capital that will sort of bring about the needed change or development in the economy. How do we go about this to change the distribution?
Well, number one, we need to look for long-term investment, create a two-way exchange system. We look at our oil sector, which is still the life wire of our economy. How much can we have in terms of sale of crude oil? And now that we want to become a net exporter of refined petroleum products, then we need to look at that. We need to look at type of investment that will attract Nigeria in the diaspora, just like what India has done to stabilize their rate for the long term. So those are the three major ways there. If you look at trade, unfortunately, we are not able to meet trade because of the challenge in terms of infrastructure and in terms of the two-way exchange system that is very difficult. And again, we have a lot of bottlenecks, makes our product very, very cheap. And then in the international market compared to other products, then in terms of quality, we are still low. So that's why I won't talk about trade now. Those are the long-term process that you have to put. But I think the good thing about it is that if you look at this number, you realize that financial instruments were more. So we are entering into a phase of the banking recapitalization. We are going to attract those funding. Okay. And I think they are going to be long-term, especially when we recapitalize this bank. And if you look at that numbers, like Citibank, I'm very confident.
I'm afraid we have to go now. Thank you so much. We get the point. Thank you, Muktar Mohammed, CEO Asheer Investment, for your time and your thoughts on the show today.